When uncertainty rises, capital changes behavior. It becomes less ambitious, less speculative, less concerned with upside. It looks for structure. In moments of crisis, financial shocks, inflation spikes, tightening policy, money does not disappear, it reallocates. And very often, it reallocates into bonds. You see, bonds are not exciting. They don't promise growth, but they do offer defined terms in an undefined environment. Whether that be a fixed payment, a maturity date, a contractual obligation, in a volatile world, that structure becomes valuable. Today, we're not talking about bond trading strategies. We're not talking about maximizing yield. Today, we're talking about what bonds actually are and how they function inside our financial system. At its simplest level, a bond is a loan. When you buy a bond, you're lending money to a government, a corporation, or a municipality. In exchange, you receive periodic interest payments and the return of your principal at the end of maturity. Unlike stocks, bonds do not represent ownership, they represent obligation. This difference matters. Stockholders participate in upside and downside, while bondholders prioritize repayment and income. In the capital structure of a company, bondholders are paid before shareholders, and that's because bonds are not built for excitement, but they're built for predictability. Stocks are discussed in price, bonds are discussed in yields. Yield reflects the interest income, the bond's price, and the time remaining until maturity. When bond prices rise, yields fall. When bond prices fall, yields rise. This inverse relationship is fundamental. It's also why bonds respond directly to interest rate changes. If a central bank raises its rates, newly issued bonds offer higher yields. Older bonds with lower yields become less attractive, and all around their price falls. It's not speculation, it's math. Here is where bonds become structural. A bond sensitivity to interest rate changes is measured by duration. The longer the maturity, the more sensitive the bond is to rate movements. Short-term bonds offer lower volatility, lower yield, but more stability. On the other hand, long-term bonds offer higher sensitivity, larger price swings, and greater exposure to policy shifts. This distinction became very visible in 2022. When central banks aggressively raised rates to combat inflation, long-duration bonds experienced historic declines. Many investors assumed bonds were inherently safe. What they discovered was that stability depends on the structure. In times of crisis, investors sell risk assets, demand for government bond rises, and yields fall. We saw this clearly in 2008 during the financial crisis and in 2020 during the pandemic shock. Capital fled from uncertainty and moved into treasuries, not for growth, but for preservation. Bonds function as a stabilizer because they are tied to monetary credibility. The yield curve compares interest rates across maturities. Normally, longer-term bonds yield more than short-term bonds. Why? Simple. It's because time carries uncertainty. When short-term rates exceed long-term rates, the curve inverts. Historically, yield curve inversions have preceded recessions, not because they cause recessions, but because they reflect tightening financial conditions. The bond market often anticipates economic slowdowns before equity markets react. Bonds don't respond to volatility, they often signal it. Not all bonds are equal. Corporate bonds, for example, carry credit risk. The difference between corporate bond yields and government bond yields is called the credit spread. When economic conditions are strong, credit spreads narrow, and investors accept less compensation for risk. When uncertainty rises, credit spreads widen, and risk premiums increase. This widening reflects fear or default. Credit spreads are a real-time measure of economic stress. Again, bonds are not passive. They are diagnostic tools for the health of the system. Bonds sit at the center of monetary policy. When a central bank raises its rates, short-term bond yields adjust immediately. When they conduct quantitative easing, they purchase government bonds, suppressing yields and increasing liquidity. Bond markets are the primary transmission channel of monetary policy. Stocks respond to earning expectations. Bonds respond directly to policy. This is why they are foundational to financial stability. Stability does not mean no movement. It means structured risk. Bonds provide predictable income, defined maturity, seniority and repayment, but they are not immune to inflation, policy shifts, liquidity stress, and much more. True stability depends on duration, credit quality, and macroeconomic conditions. Misunderstanding this leads to overconfidence. Understanding it leads to allocation discipline. Volatility is uncertainty. Uncertainty increases the value of predictability. Bonds offer defined cash flows in a world of variable outcomes. They anchor portfolios not by eliminating risk, but by structuring it. When equity markets fall, bonds can provide balance. When policy shifts, markets respond first. They are not dramatic, they are not explosive, they are foundational. When policy shifts, bond markets respond first. They are not dramatic, they are not explosive, they are simply fundamental. In volatile environments, investors look for certainty. Bonds do not offer certainty about the future, they offer certainty about terms. Interest rates, the maturity, the repayment structure. Understanding bonds is not about chasing safety. It's about understanding how capital seeks stability when everything else moves.